Now for this strategy, another indicator you have to use is the ATR, or average true range. And this tells you the average volatility of the stock. In other words, how much does the stock move on an average trading day? So how do we find the ATR, or average true range? I'm going to show it to you right now. First, let me remove all the studies so you get a clear chart. Okay, there we go. Now, what we do is we go to studies again, go to this study. And again, you can use this on any charting software, TradingView, TC2000, anything would have this. It's very common. It's called ATR, average true range. So click on that. And by default, you get the 14-day ATR. So leave it as 14, click OK. There we go. So you see this line. In this case, it is purple, can be any color. So this line measures the average range of that day. Okay, so it goes up, it goes down. So which one do we take? Now, usually what I do is I look at the last 3 months. So notice that this is a 6 months chart. So I'm going to change it to 3 months. Okay, so this is the 3 months chart. And what I do is I put my mouse or my crosshair to the top. So the top is, you can see here, the number here is 4.21, $4.21, which means in the last 3 months, this stock, POOL, moved $4.21 in a day. That was the highest range in a day, 4.21. And the lowest range in a day was 2.67 or 2.68 or 2.69, whatever, right? So 2.69 and 4.22. So I take the average. So 4.22 plus 2.69, add them together and divide by 2, I get 3.45. So 3.45 would be somewhere about that. Okay, so basically what I do is I look at the last 3 months and I take the average ATR for the 3 months. In this case, the answer is $3.46. So what does this mean? What is the meaning of ATR? It means on average, this stock moves by $3.46 per day. And this is important to know because when you place your stop loss, you want to ensure that you place a stop loss at least 1 ATR away or more. Because if the stop loss is too close, you'll get hit by the daily volatility. So this will tell us that we have to put our stop loss at least $3.46 away from the next level of support, ideally, or the next level of resistance. And I'll talk about that more in a while. Now, another way to calculate ATR, which is kind of like a shortcut if you're lazy and don't want to do this, is you can just go to Finviz. Let me see, there's Finviz over there. This website, Finviz. And if you click on any stock like pool, you can see that they will also give you the ATR over here, 297. So sometimes there could be a bit of a difference, right? So they give 297 and I'm using 346. That's probably because they're using the current ATR right now, 297, whereas I'm using the average of the last 3 months. So I prefer to use the average, but you can also use the current ATR as well, right? So it doesn't have to be exact. As long as you get something around there, it's fine. And that's how you find ATR. Alright, so now that we've covered the bits and pieces, let's put it all together into the entry rules. So whenever I'm going to go long on a breakout from consolidation, I have to ensure that all these entry rules are being met. Now the first thing is always remember, before you go long on an individual stock, always ensure that the index is on a clear uptrend. So because I'm trading the US stocks, I'm always looking at the S&P 500. So I always want to ensure that first and foremost, the S&P 500 is bullish, right? And I look at the SPY as the ETF to measure this. And you can also use the SPX, which is the S&P 500. So you have to ensure that the S&P 500 is bullish, where the 20 exponential moving average is above the 50 moving average, and the S&P 500's price is above the 20 EMA, right? So always ensure that the overall market is on an uptrend. Next, ensure that the stock itself is also in a bullish sector, okay? So again, if you're trading Facebook, right? Facebook is in, for example, the technology sector. So always ensure that the technology sector is also on a clear uptrend. And I've talked about this in the basic professional stock trading course on how you go to Finviz. Remember, go to Finviz and look for the sector and ensure that the sector chart is on an uptrend. So that's always the first step in any trading strategy, okay? Now, specifically for this strategy, we always want to ensure that the price is in a consolidation pattern. Again, I've mentioned before, it has to be making same highs, and resistance has been tested at least 3 times or more, right? So take a look at this graphic over here, right? It goes up test 1, test 2, and at least test 3. Next, we also want to ensure that upon the breakout, the uptrend is confirmed by the moving averages. So the 20 EMA must be above the 40 EMA. And the 50 simple moving average should be above the 150 simple moving average. Or the price of the stock should be above the 200 simple moving average. And the 200 simple moving average must also be sloping upwards. That is also an indication of a medium-term uptrend. Next, ensure that 1 out of 3 momentum indicators are bullish. So I've explained this recently. Remember the force index or the parabolic SAR, which is the dots below the candle, and the MACD, one of them has to be bullish when you're going long. Okay? Now, how do you know it is a valid breakout? Because like I said, there are many times you have what we call false breakouts. A false breakout is one where, okay, it looks like the price is, getting out of the resistance and people buy, and the moment they buy, it goes back down again. So it's kind of like in sports. In sports like basketball or football, they fake you, right? They fake you out. So you want to avoid being faked out. So, how do you avoid many of these false breakouts? So let me show you what I look for. Now, the first thing is, to me, the safest breakout is when a candle body opens and closes above the resistance level. And I call that a breakout candle. So in other words, this line that you see, that's the resistance line. So again, let's imagine that's $10. So I want to see that there's a full candle body above the resistance level. So the opening and the closing of the day is above the resistance level. Now the lower shadow of the candle, it can go below the resistance, that's fine. But ideally, I do not want to see the body of the candle where, or rather, I do not want to have a situation where, right, one part of the body of the candle is above the resistance and the other part is below the resistance. I want to see the full body of the candle above the resistance. It's kind of like a prisoner ensuring his whole body is out of the fence, all right, before you can bet that he's going to run away, right? You do not want his body to be half in the fence and half out of the fence, right? So that's what I'm talking about over here, right? So full candle body appearing outside the resistance level. Now, the other thing that's really important is when it breaks out of consolidation, ensure that the breakout candle, which is again this candle, that prisoner who just escaped, ensure that the breakout candle should be near or ideally touching the 20 exponential moving average. Why? Remember that whenever the price is too far from the moving average, it tends to be overextended and it tends to snap back to the moving average. So we want to ensure that when it breaks out, it has not been overextended. And again, one way to tell is that it is near or ideally touching the 20 moving average. And I'm going to show you some examples later on when it's too far away and we don't take the trade, because if it's overextended and you buy, right, it will tend to snap back. Instead of going higher, it will tend to come back before going higher and it may hit your stop loss. So that's really important. It must be near the 20 exponential moving average. Now, once you see this breakout candle, do you buy immediately? No. Now, remember that we are basically trading a daily candle. So each candle represents one day. So you must always wait for the candle to close and make your decision. Do not make the decision while the candle is forming. And that is why we make our decision only when the market is closed. Because when the market is open, the candle is still moving, you don't make a decision then. Wait for the market to close and then you make a decision. You place the order before the market opens the next day. Okay? So let's imagine currently the market is closed right now. And what I'm seeing is yesterday's candle. This is yesterday's candle. Okay? So I'm anticipating that today when the market opens, the price will continue running higher. Okay? So I only want to buy if the price keeps going up. If the price goes back down, like after the breakout candle, if it goes back down, I do not want to be a buyer. I only want to buy if it continues going up. So how can I be ensured of that? That is why I place a buy stop limit order a few cents above the high of the breakout candle. Okay, so I have to check what's the high of the candle, and I place my buy order a few cents above the high of the candle. And again, it's a buy stop limit order. So again, what is a buy stop order? Recall from our previous lessons in the basic course. A buy stop order is one where you buy above the current price. Okay, so that's what we call it, a buy stop order. But we must also place a limit to ensure that we do not pay too high a price. So there must be a limit to how much you're willing to pay. So how many cents do I use? Well, again, this is just a rough rule of thumb. If it's a stock that's below $5, I will use 1 cent. If the stock is between $5 to $10, I use 2 cents. And again, this is just a rule of rough gauge, right? If the stock is between $10 to $50, I use 3 cents. If the stock is between $50 to $100, I use 5 cents. And if the stock is above $100, I use 10 cents. Okay, so let's imagine this is a $20 stock and it breaks out. So where do I put my buy order? I put my buy order 3 cents above the high of the candle. Okay, so why do I do that? Because when the market opens, if the price goes up, continues going up as I anticipate, and it goes 3 cents above the high of the candle, it will trigger my order. The broker will buy and fill my order, and I'm in the trade. Okay, but if the market opens and the price does not continue going higher, the price in fact goes back down, that means it was a false breakout, it never triggers my buy order, so I will not get in. So by doing this, it ensures that I only get in if the prisoner continues running away. If the prisoner goes back to the prison, I don't buy, right? So that's why I use a buy stop limit order. Okay, now at the same time, I have to place a stop loss, because again, the moment I buy, it's going to run, but it could still come back down and be a losing trade. So I have to protect myself, right? So I'm going to place a stop loss 1 ATR below the support level. Okay, 1 ATR below the support level. So remember that the resistance, once it breaks out, it becomes a support. So when I mention the word resistance and support, it's the same line. It's the same thing, okay? So I place my stop loss 1 ATR below the support level. And we just learned how to calculate ATR, right? I just showed you from the charts, or you can look at it from FinViz. Now, so we've got our buy order, we've got our stop loss. Where do we exit the trade with a profit? Well, there are two options. Number one is you can put a fixed target price, 2R or 2.5R above the entry price, or you can simply not have a profit target. In other words, the moment you buy, you stay in the trade, you ride it all the way to the end, till the trend ends. How do you know when the trend ends? When the 20 exponential moving average crosses below the 40, 20 below 40, short-term downtrend, that's when you exit. So that's another option you can use. So there are two ways to exit, a fixed target price or when the short-term trend reverses down. So let's take a look at a few examples right now. So let's take a look at some recent examples of breakout from consolidation, entering on the first breakout candle. So this example is on Lockheed Martin, LMT. And let me show you first of all the big picture. As you can see, it was in a consolidation. If you draw the resistance level over here, right, you can see that's tested once, tested twice, tested 3 times, tested 4 times. And you can see that this was not a valid breakout. Okay, why was it not a valid breakout? Because we need to see a full candle body, a bullish candle above the resistance. So you can see that this candle was kind of like half the body was in, half the body was out. It was not a clear breakout, and this was a bearish candle, so that's not a breakout as well. So you can see that it's making same highs. Remember, it must always make same highs and same lows or higher lows. In this case, you can see it is making a higher lows. So it's that pattern we talked about, flat resistance with a higher lows, like a wedge pattern, right? So where's the breakout? So the breakout's over here, right? So this over here, this candle, this is the breakout candle because it's a full candle body that forms outside the resistance level. Now, at the breakout, again, ensure a few things. Number one is the 20 above the 40 EMA. Yes, you can see this red dotted line above the blue dotted line. Check. Is the 50 moving average above the 150 moving average? Yes, check. So moving averages indicate a short-term uptrend and a medium-term uptrend. Next, at least one of the indicators bullish. All right, you can see the parabolic SAR, the dots are below the candle at the breakout, so that's bullish. The force index, which we learned earlier on, it's above 0, so that's a bullish force index. The MACD, we have got the bullish histogram with the black MACD line above the signal line. So in fact, we've got 3 out of 3 indicators bullish, so we're good to go. So once we see this pattern, where do we place our buy order? We place a buy stop limit order just above the high of this candle. Okay, so this candle or this stock is a $300 stock. So for $300 stock, you could use 10 cents or even 20 cents. You can put the buy order 10 or 20 cents above the high of the candle. Okay, so let me show you a closer look. So this is the zoomed in. Okay, there we go. So let me orientate you. This is the breakout candle which we talked about. Okay, and if you put your cursor on the candle here, you can see H is high. This tells you the highest point of that candle. So we just take the high and we add 10 cents because it's a $300 stock. Okay, so in this case, the high plus 10 cents is $327. So that's my buy stop limit order. So remember, when you place a buy stop limit order, there are 2 prices. There's the stop price and there's the limit price. So the stop price is your intended entry price, which in this case is 327. So that means the next day, if the price goes to 327, it would trigger your order and convert it to a market order. Okay, once it reaches 327. And market order means it will buy at whatever is the market price. So we must always put a limit. So I could suggest that if you're entering at 327, you can put a limit at 327 and 10 cents. Again, another 10 cents, which means that you're telling the broker, buy at 327, or rather buy once it hits 327, but not more than 327 and 10 cents. Okay, so normally you don't want to buy it too high, so you can give it a 10 cents or 20 cents buffer. If it's a $100 or $300 stock, of course, if a lower price stock, like if it was a $10 stock, you would use 2 cents. Right? If it was a $40 stock, you use like 3 cents, according to what I taught you earlier on. Right? So again, you place the limit order slightly above the stop order. But the limit order should be no more than 0.1 ATR above the stop order. No more than 0.1 ATR. Okay? Okay, so that's our buy order at 327. Where do we place our stop loss? So recall, we place our stop loss below the resistance that it has been broken out of. So remember, when the price breaks out of resistance, that resistance now becomes a support. So we now have a support. So the support / resistance is at 322.31. Right? So if the price comes back down, we expect it to be supported by 322.31. But we have to give a bit of buffer in case it goes a bit below that. So we're going to place our stop loss 1 ATR below this level, 322.31. So recall how we calculated ATR. We used the indicator on the charts. Remember that? And I said, look at the last 3 months and take the average. Take the top, take the bottom, add them together, divide by 2. So in this case, the ATR for LMT is $3.30. That's the average ATR in the last 3 months. So this tells you that this stock moves an average of $3.30 a day. Okay, so where do we place our stop loss? We place our stop loss at 322.31 minus $3.30. Okay, so that will give you 319.01. So that is where we place our stop loss. Okay, and ideally the stop loss should be below the 20 exponential moving average. Right? Remember, I also mentioned that when the candle breaks out, it should be near the 20. So you can see it's near the 20, and that's fine. If it's too far from the 20 moving average, it is extended, don't enter. Do not take that trade. Right? So in this case, you can see it's still pretty near the 20, so it's reasonable. Okay, so I'm buying at 327. My stop loss is at 319.01. So what is my risk per share? My 1 hour distance would be 327 minus 319. So my 1 hour is 327 minus 319, and that's that's $7.99. Let me just double check that to make sure I got the numbers right. 327 minus 319. Yeah, that's right. Okay, so this 1 hour is $7.99. So that's my risk per share. So if I'm risking about $8, I need to make at least 2 times of that, which is about $16. Right? So 1 hour is $7.99. What is 2 hour? 2 hour would be $7.99 times 2, so that's about, well, roughly about $16 or $15.98. Is that correct? Yes. Okay. So if I want to place a target price, my target price would be the entry price, which is 327, all right, plus 2R, plus 1598. So my target price would be 342.98. And you can't see it on the chart because it's way up there, all right? Okay, so once we entered the trade, we placed 3 orders. The buy order the stop loss, and if you want a target price. Again, you can choose not to place a target price. You can choose to let it run and exit manually when the 20 moving average crosses below the 40. You can also do that. So let's take a look at what happened to this trade. Okay, so here's what happened. So as you can see, we entered here. So the next day, the candle exceeded the high of our breakout candle at 327, so it triggered our buy order. So we bought at about 327. Our stop loss was at 319, and our risk was 799, recall that. And our target is 2 times of that, which is about 1598. So that puts our profit target at 343.08 over there. So once it went up, you can see it came down slightly, and then we hit our profit target. So this was the winning trade. It hit the profit target. All right, so next example is on OKSB. Again, this is a recent trade, and you can see, again, the big picture, it was in a consolidation. So it tested once, tested twice, tested 3 times. Right, so that is same. So again, remember, same highs, same high, and same high, making same highs. And this case making same lows, and same lows. So same highs and same lows, it's a clear range. All right, so we have got that criteria. And where's the breakout candle? So again, all these are not breakout candles. This is the breakout candle. This candle over here, that's a breakout candle. It's the first full body candle that gets above the resistance level. All right, so again, at the breakout candle, ensure it is near the 20 moving average. So it's pretty near, that's fine. It's not overextended. The 20 is above the 40, as you can see. 20 moving average above the 40 moving average. So that's a short-term uptrend. Now, at this point of time, you can see now, at this candle, you can see that the 50 moving average is still below the 150. All right. Now, I did mention that the 50 moving average must be above the 150 moving average, or the price must be above the 200 moving average. And the 200 must be sloping up, right? Do check the entry rules again. So in this case, although the 50 was below the 150, but the price was above the 200 moving average, which is this thick red line, and it is sloping up. So that validates the trade. That's fine. Do we have our indicators bullish? Yes, our parabolic SAR, the dot is below the candle, so that's bullish. Force index is above 0, that's bullish. MACD is bullish as well. So we have got 3 out of 3 indicators bullish. All the stars are aligned. We can enter the trade. So where do we place our buy order? Once again, we place our buy order just above the high of this candle. So this is a $20 stop. We can put it 3 cents above the high of the candle. So let's take a closer look. Okay. So this was the candle we were referring to. That's our breakout candle. Again, place your cursor on the candle, and you can see what was the high of the candle at that point of time. Okay. Now don't look at this figure, because this figure is one that was captured. You have to look at the one which you are looking at. Okay. So we place our buy order just above the high of this candle, and the high of this candle. Yeah, I can't remember what the high was, okay, but again, you put 3 cents above the high is 26.59. So obviously the high was at 26.56. Yeah, so 3 cents above is 26.59. So we put a buy stop limit order where the stop price is 26.59. So the next day, if the price goes to 26.59, it would trigger the order and convert it to a market order. And you'll buy at whatever is the market price. So again, we have to put a limit, right? So we could put a limit at, again, maybe a couple of cents above that. So you can put a limit at 26.62 or 26.65, right? So again, give it a bit of buffer, but do not put the limit price more than 0.1 ATR above the stop price. Okay, do not do that. Okay. So that's our entry. Where do we place our stop loss? Our stop loss would be again 1 ATR below the resistance level. In this case, the resistance is at 26.56. Again, calculate your ATR by going to FinViz or using the ATR indicator which I taught you earlier. So in this case, the ATR happens to be 45 cents. Okay, so our stop loss would be 26.56 minus 45 cents. So that puts our stop loss at 26.11. So that's our stop loss, that's our entry price. So again, if you take the difference between 26.59 and 26.11, this is our risk per share, 1R. Okay, so again, if you want, you can put a profit target of 2R, right? So that you exit and make double your risk at any point of time. Remember, when you lose $1. When you win $2. That's how you win the game in the long run. Okay, so that is OKSB. Another example is BOOT, boot. Again, notice it's in a clear consolidation. Same high, same high, same high. Test 1, test 2, test 3. Same low, same low, same low. Test 1, test 2, test 3. So tested 3 times on both ends. That's a clear resistance level. Now, where's the breakout candle? This, well, actually, this was the breakout candle, this one. Okay, this was the breakout candle because, again, the body of the candle was outside the resistance. So that was the breakout candle. Now, this one was actually a bit risky because you can see that by the time it broke out, it was quite far from the 20 moving average. Can you see that? It's a bit far away. Remember, the moment the price gets too far from the moving average, it tends to snap back, which you can see it did snap back here, right? So that's why I say when you buy, when it's far from the 20 moving average, it's a bit risky, right? It's a bit risky. So in that case, I'll teach you later on to wait for the price to come back nearer the 20, test the resistance, and then enter as it pulls higher. So I'll talk more about that in a while. That's a secondary entry method when the price is overextended. So let's take a closer look. Now again, notice the moving averages are in sequence. It's bullish. 20 above 40, 50 above 150. Notice also that your indicators are all bullish as well. All right, so all the stars are aligned. Okay, so in this case, yes, correct. This was the breakout candle. As you can see, breakout candles over here. And we place our buy order just above the high of this candle. Again, it's a $20 stop, so we can put 3 cents above the high. Entry at 20.05. Stop loss 1 ATR below the resistance. In this case, it's 18.50. So our entry price, our stop loss price. And you can see that it's good we place our stop loss far enough. So what happened was when it broke out and it came back, it did not hit the stop loss. Right? If you had put your stop loss too close, it would have gotten hit. You would have ended up selling the stock, and then the price would have gone up without you. And that's what happens when you place a stop loss too close. That is why we place a stop loss 1 ATR below the resistance to give it a bit of buffer. So this ended up to be a pretty good trade as well. Now, here's an example of a breakout that was really overextended. That's something that I really would not take. So I want to show you an example of what I mean by being overextended. So again, you can see it's a range, all right? And you can see it's making same highs, same highs, same highs, right? Test 1, test 2, test 3, and boom, it breaks out over here. That's your breakout candle. But notice this example is one when the candle breaks out, what has happened? It is already very far from the 20 moving average. Can you see the 20? This is the red line. It's a bit too far. Okay? So when you enter there, it's overextended. It's like a rubber band, right? You buy there and then boom, it snaps back to the 20. And you would have definitely hit your stop loss in that example. All right? So be careful. Again, if it seems too far, don't take it. Rule of thumb is that your stop loss, when placed should be below the 20 moving average. If your stop loss is above the 20 moving average, that means your entry is too high. It's too far from the 20 moving average. So that's a good gauge, roughly. In instances when the candle breaks out of consolidation and it's far from the 20 moving average, it's overextended, like I said, don't enter. So what you want to do in those situations is, for example, if the candle breaks out, right, and again it's far from moving average, what I'll do is I will not enter on the first breakout candle. What I'll do is I'll wait for the price to come back, and again, it doesn't always come back. So if the breakout is really strong and the price keeps flying, then of course you would miss the bus. And in that case, don't chase it, look for another setup, okay? But there are times when the price breaks out and it will then retrace back to the resistance. Remember, when a stock breaks above resistance, the resistance becomes support, absolutely, right? Resistance becomes support, support becomes resistance. So when I see a breakout candle here again, if I do not want to enter on the first breakout, because again it's overextended or the candle's too big, I'll wait for it to come back and to test the support. And what do I mean by test the support? I mean I want to see the candles coming back and kind of like hitting the level of support. Okay? And now, if it hits the level of support, I will enter if I see some kind of bullish candlestick pattern. Like for example, I see a bullish pin bar, which is a small body candle with a long lower shadow, which I talked about in the basic course, about understanding the different candlestick patterns. Or if I see kind of like a bullish engulfing pattern, when I see a big bullish candle, I will then enter it, right? So this is what I call buy point 2. When I buy, only when it retraces back to the resistance to support level. And again, at this point when I'm going to enter, I want to ensure that it's near the 20 moving average again. So when I see that, I'll put my buy order, again it's a buy stop limit order, a few cents above the high of that candle. And similarly, my stop loss is placed 1 ATR below the support and resistance level. Okay? So let me just read basically what I just talked about. If the breakout candle is overextended, wait for a retracement and a retest of the resistance/support level. Enter a buy stop limit order above the high of the first bullish candle pattern that appears after the retest of support, which is over here. I'll show you a few examples in a short while. Again, your entry should be near the 20 exponential moving average. The stop loss is placed 1 ATR below that support/resistance level. Again, when you exit the trade, you either place a fixed target price of 2R or you exit a trade when the 20 EMA crosses below the 40 EMA. Now, I know some traders who prefer to enter on the buy point 2 and not the buy point 1, and that's fine. Okay, in fact, if you're more conservative and you want to avoid a lot of false breakouts, it's better to take buy point 2. But the only downside about waiting for buy point 2 is that if it breaks out from buy point 1 and it keeps running, it doesn't retrace, you'll not get a chance to get it. So it's really up to you which style you like. Most of the time, I will enter at buy point 1, but again, if it's overextended, I'll wait for buy point 2 to enter on the retest of support. So just to a few mentions, buy point 1, enter just above the first breakout candle. Let me just highlight that there. Okay, ideal when the price is near or touching the 20 EMA. Buy point 2 is used when the first breakout tends to be overextended. All right, and that's when we use it. But again, when you wait for buy point 2, you may miss some breakouts that don't pull back. But the good thing about buy point 2 is that you avoid some of the early false breakouts. Sometimes it breaks out and then it comes back down. Waiting for buy point 2 avoids many of those false breakouts. So if you just want to take buy point 2, go ahead. There's nothing wrong with that. It's actually a more cautious approach. So let's look at a few examples of this in action. Again, we're looking at IBOC. You can see it was in a consolidation, resistance, test 1, test 2, test 3, test 4. So very strong resistance, and this was the initial breakout. That's the breakout candle. And again, you could have entered on that first breakout candle, but if you think, hey, you know what, it's a bit far from the 20 moving average, I'm going to wait. And sure enough, you let it go, all right, let it go, and let it retrace and come back to that resistance. And remember that resistance now becomes a support. So it goes down and it goes, it hits the support and bounces off. And again, notice as it comes down, it forms this bullish pin bar. And this bullish pin bar is a bullish reversal pattern. It tells you that, okay, the price attempted to go down, but it was rejected from the level. So this is a very good pattern to tell us that the price is reversing. So once you see that bullish pin bar, you could put a buy order right above the high of this candle. And again, the stop loss will be 1 ATR below the support resistance level. Again, ideally ensure that one of the indicators remain bullish. In this case, you can see the force index over here was still bullish. But the parabolic SAR turned bearish. Okay, and the MACD, well, MACD is, yeah, it's turning bearish as well. So you've got at least one of them bullish, that would be a safer entry. Okay, so this is a good example. Let's zoom in and take a look at it from a closer angle. Again, you can see it broke out. This was the first breakout candle. If you did not want to take it there, wait for it to go up, retrace, and form this candle here. That's a bullish pin bar with a small body and a long lower shadow. Again, do revise my lesson on candlestick patterns in the basic course under technical analysis to remember some of these candlestick patterns, right? So once you see that, and look at it, it is not only testing the support, it is also testing the 20 moving average. So that's a very, very strong level of support. It's being tested by a moving average and a support level. So I've got high confidence it's going to bounce. So I place my buy order a few cents above the high of that candle. So again, it's a $44 stop. So I'll probably use 3 cents, right? So my buy order is at $43, which means the high was probably at $42.97. So 3 cents above is $43. My stop loss, again, I measure 1 ATR and place a stop loss 1 ATR below 42.35. So in this case, it's 41.50. So once I have that, this is my 1 hour distance. Okay. And again, notice the ATR is 85 cents in this case. So 42.35 minus 85 cents, that gives you your stop loss level, right? So that was the entry for IBOC. Okay, next example is LMT, Lockheed Martin. So again, you can see it was resistance. Now over here, you can see this was a breakout candle. Can you see that was a breakout? Now that was a false breakout because it broke out and came back down, right? So the moment you saw this candle, you could have placed your buy order above the high of the candle, right? And the next day, what happened? The price did not continue, right? It did not go higher, it came down. So your buy order would not have been triggered. And that's why we use a buy stop order, so it doesn't get triggered if the price does not continue. So it avoids these false breakouts, right? So there's a test 2, there's a test 3, and over here it breaks out. But this breakout candle is not convincing because it's a bearish candle, number one. Number two, it kind of like gaps up. So it's, again, far from the moving average. It's a bit risky to enter at that point of time. So we don't enter here. So in this case, again, it's far from the moving average. Let it go up and retrace. And again, you see it's retraces, coming back, boom. And again, it forms that bullish pin bar. And it's now finding support at the previous resistance. Boom, beautiful entry. Again, ensuring your force index, your MACD, your parabolic SAR, one of them remains bullish. Okay. So we place the buy order above the high of the candle, stop loss, again, 1 ATR below the support level. And what happens? The next day, it goes up, hits our buy order, we're in the trade, comes back down, doesn't hit the stop loss, and boom, it goes up. Right? So that's another example of the trade. Right? This is a closer look at that same trade. Again, that was the bullish pin bar. That's my buy order, that's my stop loss. Okay. So I hope you're getting a hang of it and recognizing these patterns that I use to trade. Okay, ODFL. Let's look at one last one. Again, consolidation. You can see resistance, test 1, test 2, test 3. And this was the breakout candle. And again, you could have entered on that breakout candle, right? You could have. But if you didn't want to, you could say, okay, let's wait for it to go up and again come back down and test that resistance turns support. So it goes up and hits that, bounces, and you could have bought here. So this was a buy point 1, buy point 2. So you could have entered in both, right? So again, both entries would be valid. But again, if it broke out and it ran, never coming back, again, don't chase it, look for another stop, right? So this is a secondary way of entering the breakout pattern.